Hi, everyone. Welcome to the TimingResearch.com Analyze Your Trade episode for September 1st, 2022. We are recording this at 4 p.m. Eastern Time. This is episode number 196, and this is the second episode of the new monthly format. My name is David Kosmeter. I'm the creator of TimingResearch.com, and today I have arranged for Samantha LaDuc of LaDucTrading.com to join us. So welcome, Samantha.
Hey, welcome. Thank you so much. And happy almost end of summer.
Yeah. And so thank you for being here. And the option professor is back to moderate. So I'm going to go ahead and turn it over to him.
Thank you.
Okay, great. Great to have everybody here. Samantha, of course, always great to have. Today we had the yields on treasuries go to a 2007 high. So concerns about valuation compressions back in the picture. And of course, we've had some news on NVDA that's making the earnings compression also a risk, as growth certainly is losing some altitude. So there is a lot to talk about today. We definitely have the right person to talk about it. So Samantha LaDuc, before we get started, a quick background on yourself and what's going on at LaDuc Trading.
Oh, thank you so much. I run a trader education service for both retail and institutional. You can find me at LaDucTrading.com. From beginner traders that are in my Discord community, it's Treasure Hunters Discord, where there are a lot of momentum kind of driven younger folks that are needing a little mentorship on navigating market direction, which is what I do in large part, but in a kind of a very careful environment versus my fishing club, which is very much focused on kind of more intermediate term traders. They have been doing this for a while, a little bit more savvy, and they can kind of keep up with my macro to micro language, which is looking at the backdrop of macroeconomics that drive policies, not to mention quant or market structure and the optionality, intermarket analysis, which I do a great deal of as my secret sauce to time, directional moves, sector rotation, volatility. So basically, I am supporting traders, but they're active traders and active investors. And then I have also one of my clients for many, many years took a position with me to manage my macro advisor product called Edge, and it's for institutions. He ran a hedge fund, so he's very much bespoke consulting and sitting on Bloomberg chat, helping them as they want. So basically making that kind of outsourced macro consulting role. So basically 3 different types of communities, Discord, Fishing Club, and Edge, and very much a full community of traders. So I might be the head, but I actually have 8 full-time actively engaged, not only analysts and traders, but they're actively supporting the trade management for clients who have questions about, how best to put on an advanced option, how to manage risk. So we have a very kind of nurturing environment with analysts that are contributing across all asset classes and timeframes. So I myself look at every stock on a chase, swing, and trend timeframe. And just for kind of housekeeping, if anyone is interested in getting my take on a particular stock or asset class, definitely let me know what your time frame is. Because I run a live trading room, we might do a lot of chasing, but that's short duration versus swing trading over several weeks versus trend trading over several months or longer. So just kind of keep that in perspective, but that's what I do.
Great. And a lot of different objectives can be reached, whether you're short-term trading, swing trading, or position trading. So it's a great place to obviously get some information and stay on top of things. Well, we've got 10 stocks to work on here. The first one is the one of the day, NVIDIA. So let's start with that and see what you think.
All right. Let's kind of take a look. First and foremost, we had a massive news alert yesterday, which sent NVIDIA down decisively after hours, but semis have already been in distribution very, very strongly. In fact, NVIDIA has been a very high probability swing short since this January top in NASDAQ, but even before that. So this is the weekly time frame. This is the day. This is the hour. And even though a lot of folks like to day trade, I am very much looking at this time frame congruence as okay. You can definitely chase But a swing trade is something that is a lot more meaty. And then a trend reversal, which I believe NVIDIA was, happened back in November of last year. So it really depends on time frame. But let me just also kind of show you on this chart. It might look a little messy, but stay with me for just a minute. When I am actively recommending longs, whether it be in a sector or in a stock, I am very much using the 10-week EMA on a weekly time frame. This has been extremely helpful for position trading, for trend trading. This obviously got extremely extended. I had a thesis beginning of the year that NASDAQ outperformance of 13 years would end, and that we would have a solid pullback in the markets. I did a whole big write-up. I went on Stock Charts TV. I talked here. So basically my thesis was that the market would pull back, and obviously NASDAQ did, semis as well. This NVIDIA trade actually not only broke the 10-week decisively, but very solidly, right to the 50-week moving average, bounced into resistance, retested again. These really March short covering rally was extremely highly kind of telegraphed because of lots and lots of puts that were going to get monetized. It was a FOMO kind of short covering rally that lasted 2.5 weeks. And it formed this kind of fake breakout fast failure. And then it had a gap down. So hopefully you can kind of see this, but this cradle formation on a weekly gapped down, and that was it, the kiss of death. So there are so many within semis, within tech, that basically got a little bit too big for their britches. They went into distribution, but then Microsoft, Google, the rest, there was a lot of weakness. There was a lot of selling. So this produced obviously this kind of protracted swing short. It did rally into the 10-week again, got rejected, came down to the 200-week, had a very strong reversal off the July 15th low, which if anyone follows me on Twitter at Samantha LaDuc, I have been fascinated with the amount of volume and the breadth expansion that happened on July 15th. Kind of my mantra was everything changed July 15th. Well, semis were no exception, and it moved very strongly into higher ground. However, it still couldn't break its downtrend. It still could not break its protracted downtrend. Semis are a mess, and they're actually what I've been calling low-hanging fruit short. In other words, there are tons of sectors, you know, KWEB and SPAC and IPOs, and there are tons of stocks, ARK and, you know, the rest, that have obviously been pummeled for well over 1.5 years, and they haven't gone up off the ground. But semis are actually the most meat left on the bone short. So this was already recommended for a short as long as this 10 and 21 continued to point down. Once they start to base and turn and move higher, it's a different ball game. So the news actually for earnings was this little pop into resistance. We actually day traded that very, very strongly. It did not get back above 180, which was important for this to get defended. And obviously that fateful Friday sell-off, a 5-day or a 5-bar rule. We got a little support, you know, at the end of the day, but I contend the market is extremely weak under the surface. Volume is starting to come out, and not just the Fed quantitative tightening type of illiquidity, but sold to you indicators that I use with clients has just been incredibly on point in showing when the risk comes into the space. So some of the semiconductors are right now sitting, again, this kind of weekly support level at the 200-week, that they better get defended. They better have a very full-on stick reversal higher if they're going to get saved. Otherwise, we have a lot of lower levels.
Okay, Samantha, we figure AMD is probably going to look very similar to NVIDIA. So why don't we switch over to energy, which is really taking it on the chin this week, XLE.
Okay, so XLE, a few days ago, this was actually something that I recommended short on an oil call. You can use crude. I will actually show you this. It's kind of better. And then, of course, when you follow crude, you get a lot of bang for your buck in sector rotation. So let me just follow this really quickly. No, that's tips. Hold on. All right, so this is on a monthly, but I'm going to show it to you anyway. This is just one example. So this is crude oil. Obviously, we've tagged this 130.50 back in March. We did a lot of sideways between March and basically now. We've been supported in this kind of 85 to 95 level. We tagged 97 in crude the other day, and I really felt like that we were going to come back down and test the 85, probably even the 80 level in crude, which makes for a nice pullback in the XLE component. In fact, there are lots and lots of tech plays that have a tremendous amount of elevated puts. It's very hard, in fact, to go in and, grab an Okta or something, that's just falling off a cliff and grabbing puts now after a protracted downtrend and then a spike lower, for example, today, 33%. XLE has definitely some pullback in it. I'm a huge, by the way, energy bull, rates bull, energy bull, but this was a very large profit-taking event back in June. It also is in regards to the dollar yuan, which is China is the largest marginal buyer of commodities. Excuse this ghost print, but it is basically the yuan is heading lower. The dollar yuan carry trade is heading higher. That puts a lot of pressure on commodities, oil included. You also have the dollar moving higher, like hot fire flames. That puts a pressure as well. But the other part is it's just extended. And oil, to me, looks like it's going to come back. Crude in particular is going to come back into, let me just grab that chart again, at least 80. And that would be very nice pullback for XLE. We also have this kind of bearish engulfing on the weekly, which is very much a kind of precursor to lower levels. In fact, I see 75 right back down to 70. 70 would be XLE's trend line support from November of 2021. And I know that folks are hiding out in energy. Energy is a huge outperformer, beautiful profits, especially in refiners. But as oil comes down, and it has, and I think it has some more room to go, I can also see XLE in the oil and gas space coming down. But let me just kind of show you where I see that oil tag. Here we go. Anyway, this is what I shared with clients, which was right here is that 97 tag. It's basically the 50. And then we had a very large bearish engulfing on the day. So that was my clue that we were going to have some resistance right here. And this is basically price target. So for me, short-term bearish XLE is more of a trade, based on this lower oil print into 80 for crude. And then we'll see what happens. It could overshoot. We could definitely get a deflation spike lower, and that's going to trigger some volatility. And once we do get volatility of size, we don't yet. Once we do get volatility of size, that reprices everything. So obviously, the safety of the oil and gas space is not going to be so defended. But this is an example of this. I'm going to get rid of this real quick. The VIX right here, you can see where we really haven't triggered so much yet. It's been a really fabulous tell on how to intraday trade SPY, in fact. So NASDAQ or the S&P have obviously a very, very good tailwind if VIX can come back down below 25.20, and that would be market bullish. Otherwise, if it pierces above 27.39, it's market bearish. And higher volatility reprices everything, including the energy sector. I actually am very impressed that energy has held up so well. We also have no rotation going into tech from energy. So we had a really strong growth to value rotation before the July FOMO rally. The July 15th through August 15th rally was extremely, bulled up, and energy was just like, hanging back. So this to me is something that volatility can come in a little bit larger. We can get XLE to pull back a little bit stronger, back to this 50-week, back to this 68, and then we'll see.
All right. We know XLE is mostly Chevron and Exxon. So
Yes.
we have a couple of other stocks people are looking at that are obviously not elite. USO and PBR. And of course, PBR is Petro for Brazil. It actually was up today. So let's look at USO and PBR.
All right, so to clarify, XLE is mostly Exxon and Chevron, and these stocks are recommended trend trades for over 2 years, but they can still succumb to short-term pressure, right, and profit taking. I mean, we absolutely, I'm bullish this play as a trend, but for a short-term pullback in all of these, some are going to move a lot faster than others. So PBR, a little bit, let me just kind of, that one as well, is a little bit more sideways. It hasn't succumbed to rolling over. I don't have a particular fondness for this one, if truth be told. I really like a dozen other plays in the oil and gas space, but it has done nothing wrong on the big picture. It's obviously in distribution, but it depends on time frame. This is very choppy. So PBR to me is not a great trading vehicle. It's not a great swing trading vehicle. It's more of a trend vehicle.
And USO?
USO, I am looking at as coming back down into, well, we already have, into the 70 area, but I use this more for charting, if truth be told. So let me kind of, this head and shoulder on a weekly is foreboding lower oil. This UGA has already tagged and gone through my level of the 50-week. So you can see gasoline pulled back most sharply. So we got a little bit, we have a deflation event going on anyway in commodities, whether it be copper, steel, even the oil patch, more so than just the Strategic Petroleum Reserve suppression by the White House administration. It is very much also risk of slowing economy, slowing growth. And we can see that manifest obviously in spiking higher yields to slow down not just the economy, but also the market. I think we'll have a better chance of getting a little bit more liftoff once crude has come back down to that 80 level. I'll take a really fine look at that. Otherwise, I'm going to be looking at 75 for an overshoot. And this is again kind of the crude chart. It's getting rejected at a very important kind of technical inflation point, coming back down. USO will follow. It's a great trading vehicle, but it's not a trend trading vehicle for me. There's just too much derivative nonsense going on with the options, but I really do like the pullback and then buy it for later, especially after we get through kind of this choppy period before midterms and also midterms.
Another natural resource is in Cameco, and that's on there too. It's rolled over, I think, from its highs. CCJ.
Oh, I love this one. Yeah, so this has been, this is a trend trade. It's very much long term. I'm not sure if the one who's interested is looking at protecting a trend position, selling $30 calls we talked about in my live trading room, or $32.50. I'm very, very fond of this space for a while. Since the summer of 2020, and it's broken out beautifully, but it's choppy. It's not a smooth trading vehicle. It's more of an investment. So, and it's the best one for options as well as liquidity for the uranium space, but there are others. So again, for me, this is a great long for trend trading where you're selling calls, positioning as against a core position, but it's not a fabulous trading vehicle. It's way too choppy. And so I would need to know if they're looking at something that's more of a trade vehicle or an investment time frame, or they're just excited because Japan, we were in the trading room when I saw that news that Japan was going back, into the nuclear. And then of course it's catching on elsewhere because of the energy crisis in Europe. So the acceptance for it is obviously picking up more, but there still isn't so much of it. So there's still a scarcity, a deficit, if you will, for uranium. We used to get most of it, of our uranium resource from Russia. So now that's off the, out of play. So it's still going to have a tough time for, let's just say, a really, really strong 45-degree up and to the right type of play. It's going to be choppy to higher.
Okay, the staples were really big today. So we have Target, TGT, but I also noticed Costco and Walmart did well, as well as the discounters like TJ Maxx, as well as Ross Stores. So
My
you want to go
favorite
into the stores like that and see what you think as far as a group?
Yeah, my favorite is BJ. So this has been on my trend list for a while, like along the past 2 years. I have this core group of trend plays that they might be very volatile on a swing basis, but they're extremely longer term. Put it in a filing cabinet kind of thing and just hold on to it. Costco's little cousin right here of BJ. So I much prefer BJ's. After Target's, huge miss, largest, oh my goodness, ever, 27% drop, biggest one since 1987. This whole space has not really been very successful in getting up off the ground. Costco as well, it had this, drubbing, of course, and now it's trying. The problem is it's got a little bit of a head and shoulders. For me, this would be a lot safer to go long when it can get and close above this 571, 572 area. So once it kind of proves itself, this failed, obviously. Once it can get back in trend, that's fine. But it's a little bit under distribution, and I'm not as crazy about it, although it hasn't broken down below the 10. Some of the positive flow, which is interesting, but in a day like today where you have a lot of devastation, especially in semis and beloved tech and Bitcoin and the rest, with the MicroStrategy news, what you notice is the recession discount stores pop up like daisies. So this was an example where Dollar General or Dollar Tree, they dumped on the Target news, Target and Walmart, when Walmart pre-announced, actually not once but twice before their actual earnings release, and Target just let it rip. The point is they were quickly defended. So today, for example, we had a little strong pop in Dollar General, and I really like BJ's. But those, again, if you got a shorter time frame you're looking at, I need to know that. Otherwise, I kind of look at the weekly chart and I use that as the wind at my back, or is it a headwind, right? So there are a lot of charts that I think are short the rip. The Chinese ADRs, short the rip is descending 200-day, semis, etc. So for the ones that are actually in trend, and they might be having some volatility when the market pulls back, of course, still energy, BJ's, some of these discounters are still better bets. Absolutely, value over growth, these exponential growth plays, and those are a few examples.
Now, China's a big ball of fire over there, but NIO has that going for it as a problem, but also the fact that electric vehicles seem to be under pressure. What do you see here? And
yeah, I'm not a big fan of any of the China stocks, just because of the overhang risk with not only the SEC compliance, but also the conflict growing, geopolitical risk. But most importantly, all of these fell apart in January, February of last year, and they have not gotten up off the ground. So I'm not seeing, I'm not one that's gonna go jumping into EV plays and copper, because there's no electrification without copper. I'm not gonna buy copper, buy EV batteries or vehicles, even though they are definitely picking up, market share over time. We have an energy crisis, recharging. There's a lot of common sense or farm girl logic that basically says it might not be ready. But the China plays in particular are a big worry for me. So they have done nothing but chop about. So if you're an options trader like I am, they're a theta decay killer. And if you do not have a solid follow through on a weekly, if you can kind of see this 10 and 21 right here, that was a nice follow through. We had a great, pop up in NEO back in June, and then it's just petered out, and now it's sideways and it's doing nothing. So can't get excited about a stock unless there's a trend. No trend, there's no trade, and I'm not excited about NEO.
If we're on electric, why don't we put up Tesla and see what you think there?
And let me just answer a question that I just saw in chat. So no, CCJ as a core position, and then selling calls or buying puts around it when you're looking for volatility in the market. In other words, this is different than swing trading, for example, or chasing. In other words, selling calls is just against a core position. That's not how you participate in the upside. So does that make sense? Okay. I'm sorry, what was the last one you just asked about? I just saw the question from chat.
Well, it was we were just on NEO. What about Tesla? I mean, Tesla, is that going to fall apart, or what do you think?
I have a big, issue with NASDAQ, especially as it relates to underperformance for NASDAQ 100. So let me just bring up a chart to show you exactly what I mean as a group. And then obviously we know the weighting is quite heavy with Apple as well as Tesla. But I want you to take, just for giggles, let's do this. All right, so I'm going to spread this out. All right, so here's 2009, okay, 2013, massive QE. We had a very, very strong advance in NASDAQ. This is actually NASDAQ 100 advanced decline line, where we've had nothing but outperformance. Just even COVID, look at that, it barely pulled back. So the point was it was very fast and furious on a monthly. Now we're into distribution. Solid distribution, rollover, attempts to try and save the market, like the July 15th short covering FOMO rally, completely rejected, and then it comes right back in. So this sideways is really the market saying, which way do we go? Are we really still in a secular bull market, or are we rolling over? If we're rolling over, I absolutely do not want to be in Tesla, right? So this is NASDAQ underperformance, basically 13 years in one chart. Here's your distribution, your tap out, literally on the last day of the year and underneath. Okay, so you're saying, why are you showing me this if I'm looking at Tesla? Because Tesla is poster child of excessive valuation, celebrity CEO. There really isn't going to be an easy time in getting this going, especially in an economic weakening of growth. And there's absolutely nothing compelling about the chart anymore to make it bullish. So if anything, this is lower high, lower high, lower high with a rollover. It looks like a fabulous collapse. Beautiful, beautiful rollover coming. So to me, there's nothing in this chart that says I want to be long Tesla, whether for fundamental reasons, macro reasons. Sometimes you get some really nice optionality. Obviously they chase Tesla all day long, but there's no compelling reason aside from the drama with Twitter. This is the best, trading vehicle, and we get some great swing trades out of it. But for right now, take a look. This is the 200, and a rule of thumb: you go long into the 200 or you short into the 200. But then it just chops around. It chops around. It's chopping around. So this is not really a fabulous, in my opinion, trend play. I know there are cult favorites and there are, Tesla devotees. But for me, this is just a chop fest into lower. We've got some day bounces that are beautiful. We also have an air pocket of risk. So if Tesla starts to break down this 265, there's a lot below, and it's going to get some folks nervous. So we definitely be on the lookout. This continues to weaken, bounce, short the rip, So to me, I don't see this as a short, depends on your short term, right? I mean, if you're chasing intraday, that's different. You can go level by level and, you know, get a few points, and options are beautiful. But if you're swing trading, you want to make sure it stays above 265. Otherwise, this breaks. We've got some much lower levels, I think, revisiting the June, July kind of time frame. Basically, this 216 from 273 would be a beautiful, you know, fall, just like Microsoft. This beautiful kind of like shape, right, where it rolls over. NVIDIA, oops, sorry. Same idea, beautiful rollover. It actually took out the lows. Google has a similar look. I could go on and on, right? So there's a lot here in Tesla that is tradable, but to me, it's not safe. To me, there's a whole channel of risk below.
Well, you just had Microsoft up. That's on the list as well. And we all know that Microsoft and Apple are a big part of these indexes going up or down. So let's look at those two, Microsoft and Apple, and see what you think.
Okay, same thing. NASDAQ topped, its outperformance ended, and we've got this beautiful rollover of the 50-week. We've got Microsoft trading underneath the 10 consistently. We had this one end of quarter, you know, massive FOMO rally for 2.5 weeks in March. And we had it again for 3 weeks, 4 weeks actually, from July to August. It was 1 month exactly. But this is a gap down. So until it fills that gap, let me show you a little bit better or cleaner. Okay, maybe I won't. Anyway, until it fills this gap on a weekly, gap downs are just the kiss of death. I showed that with NVIDIA. It is absolutely no touch. In fact, this is a really great line in the sand. I'm wrong if we get back above this kind of 300 level. Otherwise, this is just making, you know, lower highs. So can we do lots and lots of dancing here at this 100 week before we fall into 200? Sure. But there's nothing here that says this is a great time to buy. For my, you know, purposes, we are still chopping about this 250 level. I know it's really kind of messy down here, but the point is I've got lots of indicators that are telling me that NASDAQ is actually still at risk of taking out strong levels of underperformance. So I'm not seeing this as a safe bet right now. There's not enough short covering in the market. In fact, folks are not hedged enough. They were hedged very, very heavily. I'll show you that kind of example. I just posted for clients, in fact. And this is very much the market, you know, NASDAQ, Microsoft, Google, Tesla, what have you. So this was very much back in March with this is put call ratio, but my version of it. Lots and lots of excitement, and then lots and lots of puts are getting bought. Lots and lots of puts are getting bought. People were so incredibly hedged going into May 12th when we actually started to lighten up. Markets started to go sideways. They started to come in for some calls. We got, you know, walloped right back in June. But the point is, they were monetizing some very large puts. That's very important. That's what contributes to a short covering rally. We had it in March. We had it in, you know, in July into August. We had also lots of volume come in and flood the market with positive breadth and positive volume, but there isn't a lot right now. So the FANG stocks are absolutely at risk of more weakness until we can get folks to basically cover their shorts, but they don't have so much on. So I still think we've got some risks here with the market not done going down, and that means until we can see some sizable reversals of these patterns, like in Microsoft, right? Where it actually can base and then get back above the 10 and 21 and then get back, you know, into this gap fill and then get above this gap fill. I've got basically short the rip as my mantra for tech.
You know, last year, the key was to predict that energy shares were going to have monster earnings and the stocks were going to go through the roof. That's exactly what occurred. Right now, I'm thinking there's a potential for the banking stocks to have tremendous profits due to their efficiency, their credit card money they're going to make, and of course their free interest income, which is going to be huge. Do you see the possibility that bank earnings could be huge next year, and there could be a big hit on the upside to the banks? What do you?
I recommended XLF, XLE, and XME swing short 3 days ago, and there are a few reasons for that. First and foremost, I know I can't show it so easily, but the China, the deval of the yuan is actually a big hit to reflation trades. So commodities, and not to mention, XME, that was the other one. Commodities succumb to some pressure, right? So we definitely, that was first price target. This is second price target. So XME, XLE, XLF are oftentimes reflation trades that trade together. So I recommend that those definitely can have a short covering rally. You're talking about next year. So that's a really tough one for me. I actually think banks are going to, we got to get through this year first, but I think banks are a great swing short with commodities, with energy for the short term. Let oil drop down into, that 80, 75 area, stabilize, and then move back up. We could obviously keep going with this 10-year, but I think we're about ready to top out soon. And by that, I mean the 3-month is very, very, very extended. So this 13-week or 3-month, which is the shortest end of the yield curve that the Fed can control and obviously keeps lifting, is getting to a point where I think we're going to start to break stuff. 2.984, and is
yeah. The reason I was talking about 2020. Yeah.
Go ahead. I can't hear you.
No, I just say the reason I was talking about next year is obviously we're trying to make a large amount of money over a period of time, like you did by buying shares of energy last year and then letting it go way up in June and dumping them in June. So on the earning, like put a Bank of America. That is a company that is probably going to have a lot of credit card usage, and they're going to have a lot of net interest income, which means they don't pay anything on their deposits, and they're going to be able to earn quite a bit of free income there. So that obviously would be very profitable. This is obviously one of the biggest holdings of Buffett. So is it possible this thing could have a big year next year? Or is any on your longer term charts, is anything telling you there could be a low in here?
I'm very skeptical, honestly. I think that we're going to have more volatility, not less. I think growth is obviously going to get hit even more, especially in semis. I am not thinking housing is going to fall apart like many do, but I definitely think banking is going to be under pressure. Home builders, we already know they've been under pressure. I don't see a big change for this, higher yield regime, except in a deflation spike because recession risks rise. With recession risks rising, we're going to have more contraction, I think, in the banking space. But you're making a fundamental bet for next year, and I'm really just looking at it from a perspective of getting through this one. So I would have to see a lot of repair. In other words, you see it as a buying opportunity. I see these as broken. So for me, in order to get all bulled up again, there has to be a reason. We had a really strong reason why tons of stocks, especially banks, popped up like daisies like this back in November of 2020. It was not just, some would say, the blue wave. I would say the Pfizer vaccine and liquidity. So we had Democrats expected to do fiscal spending up the kazoo. They did. And the Pfizer vaccine, which, reduced a lot of the COVID contagion fears. And we also had massive QE. So all of this was a fabulous regime for hire. Banks were a huge beneficiary of that, individual and collectively. No more. We're now in a tightening regime. We actually have suppression of growth. We actually have more unemployment coming. It's just starting. So for me to be all bulled up with banks for next year, it's not my baseline bet. I like things over paper. I think that banks will have a tougher time navigating next year.
Yeah, I agree. To be clear, I'm not buying these things now. They're on my radar. because when things go way down in price, you have to start thinking about where the puck might be. And these people do make money when they have credit card usage up, and they do make money when they pay nothing on your deposits, and they can get 3 or 4% on free interest income. But that's the big story.
But I
You
think the
need to have
pool is
a
going to
trend that's
shrink.
pointing up before you actually put real money in.
I love this gap fill right
It
here.
could listen. I'm just
saying
I'm just saying it's on my radar. I'm just certainly not slamming the table. Yeah.
I would love for this XLF, for example, to fill this gap up, just like Bank of America and all of the others. JP Morgan, Wells, Wells is special. But the point is, get it back down to 25. I'm solidly interested. But I think we still have room to go, and that's the risk. That's actually the risk. So it depends on everyone's time frame. But I would love to see that gap fill. Same thing for Bank of America. And then we'll talk. But right now, reflation trades are absolutely under pressure.
That would be a fantastic buy zone if it held. Yeah.
Correct.
Like I say, earnings is key to making money on any of this stuff. And obviously, to make earnings, you have to have people using your product. And as the economy gets to where it's going, credit card usage could clearly go up high. And then the balance sheet of households is still supposed to be in good shape. So maybe they'll pay their bills, and that's a good profit center. But I agree with you 100%. This is on my radar, but dime one would not go in at this point.
What else you got?
Well, I was wondering, since we're coming into the end and we've gone over all the stocks on the list, I think everyone would love to hear if you have any stocks that you like. And again, just reiterate how people can get a hold of you and take advantage of all those fantastic things that you're doing.
Well, thank you. I think I'll go over.
We also have several questions in the
let me do that.
Want to get to any of those?
Let me do that. I see some chat questions, so I'm going to go through that. So UNH has also been a trend play. The healthcare plans, that's just, again, kind of recession risk free as it relates to we still need healthcare. So they have been, tremendously in trend of late. And when you say next 3 to 6 months, like UNH, Ruslan, I actually just recently suggested protecting profits with another pullback on UNH, likely because diamonds looked ready to roll over, which they did. And the reason why I targeted UNH is, number one, because it's a trend play of ours, and number two, because it makes up 10% of the diamonds. So I figured we were going to have some weakness coming into the UNH patch. But overall, I mean, it's beautiful. I mean, it literally has broken out, retested, broken out. It's getting a little bit more distributed, but I still like it as a trend trade. Ultimately, this can come back down to 4,600. That definitely needs to hold. And I don't know what the next 3 to 6 months hold with volatility looking so perky, right? And the potential that we can have some big risk off coming in. That's always the potential. So I would say if you can, on the short duration, needs to stay and close above 509. A pullback to this 465 area would not surprise me. That's the channel. But depending on when you went in, right, since the COVID lows, this thing has been a very nice trade, 45-degree angle, a little bit of wobble. Some that have not wobbled, like ARLP is a coal company, and I see a question about coal. This was not my horse, unfortunately, but this is a perfect example of a 45-degree angle that stays beautiful in trend above that 10-week. One dip, got right back up. BTU is another, it's not as well managed, but the point is they have still been outperforming relative to FANG, right? So relative to the NASDAQ, which has just been in a protracted, this is New York FANG, which is basically, your favorites, you all know them. Google, Amazon, Meta, Twitter, et cetera, so Tesla. So anyway, the point is the outperformance by value over cyclical only works, number one, when you have, and value VLUE doesn't work anymore because they put so much momentum in it, and they put a lot of value plays in the momentum ETF, so I can't even use those anymore. But it really, really works when you have a tighter time frame. But let me show you what I mean by that. Hold on. Here. So value, you ask about growth and value and all that jazz. So this right here, if you're playing that game, which is one I do every single day, right here, this top, that's December 31st. We had fabulous NVIDIA pricing at the top, Microsoft, Apple, Tesla, you name it, they were all there. Here's the rotation, basically, in a nutshell, from growth to value or tech to energy. What do we have outperforming in huge favor? Energy, right? Everyone then started hiding out in it. March, we had a FOMO rally. This is the March. Can you see this? This outperformance right there. That goes basically energy to growth plays. We had an outperformance, a FOMO rally, but that didn't last very long. We went right back into energy, but then that was it. So we've had massive profit taking into the second quarter, or basically second half of 2022 in those energy plays. You know, think about the PMs getting their commissions, just the whole 9 yards. And then we had a rotation, slow at first under the surface, back into growth. And then recently, I warned, careful, energy looks like it's about ready to stop. In other words, this is where you got to kind of think inversely with the market. But anyway, the point is growth, energy, and when they both sell off, you get volatility. And that's where we are right now. We're sporting some pretty large risk in volatility, in fact. So we'll see what happens with volatility. But for right now, nothing is looking particularly safe yet. But intraday, we had a nice pullback. There's kind of your head and shoulders for VIX. If we can pop right back down below 25.20, which happens to be monthly support, we can absolutely get a resurgence of the FOMO for at least, you know, a few days, maybe a few weeks. We'll see what happens, but just don't bet large on it. We still have some work to do. The KWEB. Oh, hello, Jordy, Buddha Bear. Okay, overall thoughts on DBA and EWZ. Yeah, DBA looks pretty poor. Looks like it wants to roll over as well, pretty strongly, in fact, and it's still below the 200. 200 is flat. EWZ is Brazil, but we also have the dollar, which is very much, you know, EEM, EWJ, G and J, they're all relative plays short as the dollar has moved higher. So EWZ has done actually a much better job. We're back up to that 200 and chopping about. Longer term both, DBA looks, Brazil feels in a good spot. Their crop harvest and soybeans for Chinese demand, which might help offset some of the Q3 rate hike issues. Not sure about their sugar or ethanol production until much later. Yeah, I don't know that. I know that India and Brazil, huge sugar producers. There aren't a lot of ways for retail to really play in that space, soybeans, SOYB. But unfortunately, this is why I keep worrying and talking about, and I'm talking about deflation spike is in commodities, it's in food stuff, it's in oil. Technically speaking, they look like they're ready to roll over. So it's a little bit tough for me to get excited about this until it can really stabilize here and start to move higher. Okay, dollar is hot fire flames. We know that. That's been a long, since summer of, and I will show you this beautiful chart before I get the hook here. No, yeah, so this is actually getting very extended, and TLT is very extended to the downside. I'm actually surprised with what we got, which was a sharp stick in the eye today with a TLT trade that I put on. All right, so let's see. I'm looking for that dollar chart. Here it is. All right, so this is the dollar chart I have followed. Again, red is bearish and white is bullish, but just to kind of show you, we, in my indicator world anyway, we crossed over last summer and we have moved even above this trend line with my indicator. We just keep moving higher with my indicator. We keep moving higher in the price of the dollar, which is one of the reasons why treasuries sell off in emerging markets that get a dollar spike. They are actually selling treasuries for dollars. So hence the TLT move, which was very sharp. And you probably noticed in TIPS world, it also sold off very aggressively as well. For sure, that was impressive. Let's see. Sectors, Baidu, it's definitely. So the China short covering rally, let's just do that real quick and then I'll see if I can get a few more in. So I'm not a big fan of the Chinese ADRs, as I've mentioned, but yes, they are very extended. But every time, you know, we get a little bit of movement on a news flash, like a PR event that SEC might have some plan for, you know, compliance with Chinese ADRs listed in Hong Kong, et cetera, and then it just peters out. So basically, it continues to be short the rip until we can get a viable pattern. If we get some short covering that comes into this space, then we can actually have some follow through. But even then, look at this incredibly descended 200-day. So any attempt to get up to this 200-day is going to get walloped. It's just going to be short the rip. So keep that in mind. It's going to be a while before we can get any type of basing action, any kind of trust. Even with the Babas, and PDD had an excellent earnings report. This obviously is now above the 200, but this now takes time to actually fashion and move higher. So this was actually the most bullish China play that I could find, and we need follow through. So we need to get above basically 72 and stay above. What are the chances? Okay, so I have a lot of intermarket stuff, Kenneth, and I do mean a lot of intermarket stuff. Let me just kind of show you real quick what I mean by that. You know, I do stuff in my intermarket for clients that's a little wonky. That includes, for example, that put call ratio, my flavor. I've got volume and breadth indicators that help clients stay on the right side of the trade and when to press long, when to press short. I am, you know, just posting something about GDP to rates, you know, why it matters. This is on a monthly chart. This is the US GDP to the 10-year and why, you know, GDP is going to be falling. We can't let that happen. Rates are going to be going up. So big picture. It's kind of my secret sauce, you know, my volatility tells of when it becomes important, not just garden variety, but crash worthy. This is all kinds of stuff I share with my clients, but it's not going to be something I'm going to be posting on Twitter. So with lots of explanation. And then, of course, when I warn, you know, we're getting a rollover. 10 days later, I had posted we were extended, looked like we were going to soften. We roll over in NASDAQ, McClellan summation, and, you know, for SPX. I have a whole bunch. I mean, breadth indicators, I could go on and on, right? Advanced decline lines, 50%. NYA 50R. I mean, it's stupid how much stuff I do actually every single day for clients on the intermarket front to really help them understand how extended the market is. And then here's 10 days later, boom, and we're still not even done. So my intermarket is my secret sauce. But that's not all that's in, by the way, my community. I got contributors up the yin yang here. This is like, I have got advanced options. Bob is an oil trader. I mean, solid. That's all he trades. Jordy is commodities. Here's Craig for macro advisor. Mike, excellent live trading room and also market structure. Pat for unusual option. Rithika, momentum, and Elliott Wave. Suda, guess what? Futures. So this is really a very, I think, different type of community where I run a live trading room, but I have individual contributors that are offering up their flavor, their analysis, their trades, and also their support. So if, you know, clients have questions, and then I'm giving my wonky stuff as well as my macro, right? So my macro is pretty in depth. I talk about, you know, wages being the reason for the season, outrunning productivity and how that's actually Fed's, you know, major nemesis. So there's a lot in here, both Slack for my channels, but also the contributors. I think that's basically what you're asking about. So long story short, I have a beginner product in Discord, my fishing club, which is live trading room and all of my analysis, plus 8 contributors. Macro advisor bundle is for a push only that Craig puts his comments out there. That's obviously my hedge fund manager, and he runs that product of Edge. So this is very much for those who are kind of very interested in finding out why and what is moving and how to trade it. So, and if you're looking to follow me on Twitter, I'm right here at Samantha LaDuc. And thank you very much, David, for putting this together, and Options Professor for your questions. I hope it helped.
Yeah, thank you very much, Samantha. It was a very treat to have you here. And I do suggest to everybody who either had a question or didn't have a question or didn't ask the question they had in their mind to definitely go over to LaDuc Trading and try to see if you can get more information and answers to those questions right from Samantha. Thank you very much, Samantha. It was an excellent presentation. And David, I'm going to turn it back over to you.
Yeah, excellent show. Lots of good info. So really appreciate you being here, Samantha.
Thank you so much.
Just a quick reminder for everyone, be sure to subscribe to Timing Research on YouTube and your favorite podcast app to get instant access to the recording as soon as I can post it for this episode, as well as any of the past shows and presentations. You can also just go to TimingResearch.com and the archive will be posted there as well. So I just want to thank my guest again for today, Samantha LaDuc of LaDucTrading.com. And thank you to the Option Professor of OptionProfessor.com for moderating. And that's it for today. Thanks, everyone.
Cheers. Bye-bye.